if you're going to base your grocery purchases on politics or trade wars or whatever, fine. It's not going to have as if you pay a little bit extra for those. What are they called? The Canadian ones. It's not going to hurt you as much as if you make decisions with your portfolio to boycott U.S. stocks or go full in on last year's winners.
I have to ask you, are you a Cheesies person or are you a Cheetos person?
I actually prefer Cheetos.
Traitor.
I go with Doritos.
What kind of Mexican? War's no time for soft cheesies. I have to admit that after seeing that the sketch I'm referring to, or we're talking about right now, from this hour's 22 minutes, made me think a little bit briefly when I was at the grocery store. Right? I was just kind of chuckling. It also makes me think about it too when you're holding a Tim Hortons cup. And yes, it's Canadian, but 5G, Brazilian, et cetera, right?
You could go with Second Cup, Justin. That's Canadian, and it's not crap coffee.
Or go with the little local bespoke fourth wave coffee shop down the street.
Ace Coffee in Manulife Place. They just opened their actual permanent location. Although nothing's really permanent in Manulife Place, but they had a little pop-up shop for months and months, and now they finally got the real location. And I think they're excellent coffee, and they're actually a little bit cheaper than Starbucks.
Yeah. So, it's we're laughing and joking about it right now, but I mean, like, I just had a conversation with a client earlier today, and they had made comment that the Canadian dollar where it is right now, they enjoyed going to Hawaii in the past, and they're not going this year. They might find a different location.
Belize.
Belize. You just came from Belize, right? But it's making an impact, right? We don't, day to day, I think I was joking with you just earlier as well that, the price of eggs in Canada has largely stayed the same. But I've seen a lot of headlines where there's shortages, avian flu and what have you, right? But, prices are like $8 a dozen, $6 a dozen, and that's in American dollars, right? And it's been largely stable here for a host of reasons as well. But, it kind of goes to the idea or the impact in the conversation, the things that have been coming up recently, particularly in the last 3 weeks. It hasn't been a month yet of the Trump presidency, V2, the sequel. And it's making a lot of people think. And, and sometimes, it's superficial thoughts. Sometimes it's through hockey, right? Cheering, booing a national anthem. Sometimes it goes through the investments, right? And so, I'm joking about cheesies because I am a cheesies person. I like cheesies. For those who aren't looking at the video, I'm holding a bag of Cheetos, and then I've also got a bag of Cheetos, right? And the kids, admittedly, I think have a slight preference towards the Cheetos, but I like cheesies. But patriotism, actual investment outlook. U.S. versus non-U.S., Canada versus non-Canada. We're joking. We're trying to make a light of a somewhat of a serious situation about it. But what say you?
As you're saying, we are in a bit of a trade war, and I think consumers have every right to make those decisions. I know I was actually planning. I usually drink orange juice every morning, and I was planning on not buying anymore. But then they're on sale because fewer people are buying them. They're on sale, so I'm able to get a whatever size 2-liter container for $5 or something, and why not? So I keep buying orange juice. Oasis, is that Florida orange juice or?
Well, I mean, it's a Canadian company, Lausanne, out of Quebec, in fact, right? But we don't grow oranges in Canada, right? The concentrate's coming from Florida, right? And so. How much you peel back the packaging and the labeling, and you see the sourcing of or the manufacturing, or as it says on this, prepared in Canada, right?
Prepared in Canada,
not made.
We were talking about this in Belize. In Belize, there was a lot of talk about politics in general, lamenting about Trump.
Yeah,
and why don't we import our oranges from them? Help support a fellow Commonwealth country.
Yeah,
but I just don't think they produce enough. It's a small country. They just don't have a massive orange industry that could produce enough orange juice for Canada. So we continue to import from Florida. And anyways, as things stand right now, it is at the end of February as we record this. By the time this comes out, it might already be March, and we'll know at that point if Trump is going to follow through on those the tariffs he was deferring until March 1st, I guess. I read a really good article just before this call today from Barry Ritholtz, and I retweeted it. And he talked about how the terminology he used in there, which I liked, I had to look it up even though it is German, Sturm und Drang, which basically means storm and stress. And how he goes through all those little things that Trump has been talking about, promising, and that whether it's cutting the military, taking over the Panama Canal, all of it. He went through all of it one by one, and for each of them, nope, not yet, nope. He just hasn't done anything yet. He's done a lot of talk, a lot of bluster, but maybe we are a little overly concerned about this. And this also was the impetus for my last video on how politics should not influence your investment decisions. Geopolitics, news, turn it off. It doesn't do you any good. But what we wanted to talk about today is how, from client conversations, it apparently is, and in a number of ways, I guess we're talking more about U.S. equity allocations, whether for good or for bad. What are sort of the conversations you've had so far this year?
One in particular that comes to mind is that should there be any degree of tariffs, it's the economists and the forecasters, and I think the general consensus is that the Canadian economy, because of the relative smaller size, 1/10 again of the United States, would be much more severely impacted. And so the concerns of the Canadian consumer. So if there was some stresses, if there were some potential other job losses, reduced income, would there be situations or allocations or sectors that we could look to maybe think about of reducing or keeping an eye on, just in case the Canadian consumer does have a much more of a negative impact in the near future? So that was one conversation. Yourself?
So reduce allocation to Canada, is that what people are suggesting?
Well, that was the concern, was that should we think about something like this?
So I've had conversations almost on two different barbells of the conversation spectrum. One where
I can guess,
there is just massive fear and worry about the U.S. under President Trump. Why do we have anything invested in the U.S.? Well, the U.S. is 70-something% of the world markets. You cannot avoid investing in the U.S.
No.
And on the other extreme, people looking at the last couple of years where the U.S., and we've talked about this before a number of times, the U.S. outperformed Canada especially, and really the rest of the world, by a decent margin. And they're wondering why we don't just have everything in the U.S. And of course, those are a small subset of clients. I think the vast majority of clients understand that you have to be diversified in everything at all times. And really, there's nothing to be gained by making any decisions around what's going on in the world and what's going on in politics. And that really was that impetus for that video I mentioned. What caught my attention originally, why I wanted to make a video about something like this, was an article from Dimensional Funds where they talk about the Chinese markets in Trump's first term. Yep. So in his first term, at that time it was just China that was being targeted with tariffs. 25% tariffs on not all Chinese goods, but a bunch of Chinese goods. And China had to reciprocate by cutting themselves from agricultural imports from the U.S. And at that time, too, in 2017, 2018, the U.S. was China's largest customer. Today, they're not. But at that time, you would think that would really hurt the Chinese economy to be tariffed by your biggest customer. And all of a sudden, you're having to find another source for food. Food is really vital for any economy. Whether
it's pretty important, yes.
Good or bad, you need food. 1.5 billion people, right? So how did that impact Chinese stock markets? First of all, what's interesting to see is with all this trade turmoil or whatever in 2017, 2018, and through all of Trump's 4 years originally, and you also had the pandemic at the end of that, a lot of bad news stuff happened. And yet the U.S. markets went up well above average over those 4 years. I think the number was 16%. You can double check my video. What did China do? China had all the stuff leveled against them. You'd think they'd be hard hit. They outperformed the U.S. They did something like 18% annually over that time period. And I mean, that is an above average return. That obviously did not happen in the following years, but it just goes to show that all this stuff going on in the news, it doesn't impact stocks. Maybe in the very, very short term, maybe for a couple of days if there's something bad in the news, but that, that medium term, even fairly short term over a couple of years, stock return, it's dependent on so many other things than just whatever noise is going on in the news. So, like I said,
Yeah, the news cycle is much tighter.
Yeah, my message to clients is turn it off. And what's probably the biggest taboo in investing, one of the biggest taboos, is letting politics impact any decisions you make. And there have been a number of studies done on this, how investor behavior changes based on who's in power, whether it's a Republican president or Democratic president, and just how pessimistic or optimistic the investor is.
Oh yeah, yeah, sentiment. Yes,
the sentiment. Yeah, and again, we've seen those charts in the past that show the long uptrend of U.S. stocks over the last 100 years or so, and all the different presidents, Democrat, Republican, Democrat, Republican, and how there's no real correlation there. These businesses that the stock market represents, they don't care. I guess they care a little bit who's in power, but they'll adjust. They'll wait 2 years for the midterm elections, or wait 4 years for a president's term to be over, and then they'll continue doing what they do. And if we're investing for more than 4 years, which we all should be, otherwise we shouldn't be in stocks, who cares?
What I would say, and it's not a counter to that, but everyone's a little bit different, right? And so you may have different values. You will have different values than the person next to you, right? You can have a separately managed account where you can take out specific exposures, right? You may want to reduce your exposure in certain investments to, say, the energy sector because you work in the energy sector and what have you, right? So if you needed to, you can look to diversify that away as well. And so that's a value, or that's a principle that some people may have. Other people may have that principle where, what, I really, really don't like so-and-so, right, in power. And because of that, I'm going to selectively, as a consumer, as an investor, make my decisions accordingly. And it may be correct to them, or that's their principle that they want to adhere to. And so then there's options. One of those barbell conversations that you alluded to earlier, I've had similar conversations, not as much with the United States, but more about China, right? Some people are like, I don't want anything to do with China. I don't like their human rights concerns and issues. I don't like the lack of transparency through their financials and their reporting, labor practices, what have you. I don't want anything to do with that. Other people would say, what, they're completely undervalued, right? That, there's over 1 billion consumers in that country. They're all aspiring to live better lives. It's relatively undervalued. If you were to look at, say, an Alibaba versus an Amazon, or a Tencent versus, these are all relatively undervalued to their American counterparts. Is that discrepancy actually valid? And if that's the case, then I'm looking for undervalued names. This is an area I'm completely open to, right? And so maybe they're selectively looking to add to that country. But going back to my previous point about being selective or having your own principles, right? If you don't want to invest in a certain, energy industry, the defense industry, the cigarette industry, right? There, you could find a way. You can find ways to find an appropriate allocation in a broadly diversified portfolio that takes away those idiosyncrasies, right? And it may be the United States. Granted, 77%, 66, whatever index you're particularly looking at is going to be, the United States. But you can strip that out if you want to for the time being, and then maybe find more broad international names through Canada, through Europe, through whatever, what have you, and still be largely diversified without excluding the largest economy in the world, right? It's possible, would you want to? Yeah.
Well, would you completely exclude the U.S. out of a client's portfolio?
It is darn difficult. Absolutely, it is hard to.
Yeah,
right?
I mean, it seems hard, in terms of not getting exposure to all these companies that are based there, and also just look at the last 15 years, excluding the U.S., you would have had a pretty sad return.
Everything is underperformed relative to the United States. Doesn't matter. The moment you diversified away from the S&P 500, right? In any iota amount, you've underperformed that index. Right. So the moment you bring in any amount of Canada, you bring in any amount of Europe, emerging markets, value versus growth, non-tech versus tech, right? It's, US mega cap large companies, tech companies, I should say, that have driven those returns over the last decade and a half, right? So the moment you are underweight or under, 100% market cap S&P 500, you have underperformed, right? I guess the theory there is that at some point, mean reversion or whatever description you want to call it is that there's that breadth starts spreading out to not only other sectors within the United States but other countries as well.
Yeah, totally. Home bias, and I can tell you a lot of the conversations I've been having recently and going back through last year. They kind of harken back to the early days in my career, 2006, 7, 8, up to 2013, roughly.
You didn't want to touch the United States then at that point,
Nobody
right?
wanted to touch the U.S. And yeah, you could very easily invest excluding the U.S., and most people did. When I was at the bank, I'd see some accounts at RSP time where people, the only thing they owned was the dividend growth fund, which just owned a couple of bank stocks, energy stocks, whatever. And it did fantastic up until 2007, great financial crisis, and oil prices going down to $40. But people were fine, and at that time it was like pulling teeth trying to get someone to put a little bit of US in their portfolio.
Yeah.
The problem with these bank mutual fund accounts, at least back in the day, I don't know if they do things better now. You basically see a different sales rep at the bank every time you're doing a contribution, and that sales rep had their favorite funds, and that's what they put you in. And at the end of the day, you have a list of 20 funds in your account, which is kind of comical. But a lot of times this person would come in and they have on their accounts, I'm not going to see the bank name, they got the dividend growth, the dividend income, the monthly income. They've got the balance, the Canadian balance growth and income. And all of these funds have the exact same things in them, but they've got them all in there. But they have they can literally have 20 funds in their portfolio and almost zero exposure to U.S. equities. And finally, one RSP season, they see me, and I do their risk tolerance questionnaire. We find out what's the right mix for them. I'll usually try to help them clean up that portfolio a bit and say, you should look at adding some U.S. or some global, because that was what was missing. And then what the customer would then see is the returns looked awful, because in 07, 08, just leading up to that financial crisis, so it was 06, 07 roughly, not only did U.S. stocks not do so great, but the Canadian dollar went from 62 cents to like $1.10, right? And so in a lot of these funds, you saw basically, if the best case scenario was they were flat over that time period, any gains that U.S. stocks made in their own currency, you lost it when the Canadian dollar went up. Yeah, so
the foreign exchange. The foreign exchange effect. Yeah,
and they would see me in 2006, and I put them into a global fund or U.S. fund. They see me again the next year and say, Markus, this fund went down. Meanwhile, my dividend growth fund, it's continuing to do well. I'm just going to put my money in the dividend growth fund. And, even just to get them beyond that 5 or 10% allocation to US, today it's the exact opposite. Today, people are 50% US or more. If you own the index, if you own the global index, the MSCI World right now is 73% US stocks, because US stocks grew so much over these years. So you're not even getting a diversified global portfolio anymore if you buy the MSCI World. And specifically, the ETF I was looking at with the MSCI World Index is URTH, Earth. So nowadays, you've got clients saying, I only had 40% in US. Why didn't I have more in US? Because my returns were not 30% last year. And yeah, that's kind of where we are today. And, I'm kind of saying, it's going to sound stupid in a couple of years or maybe in a decade or so. It'll sound stupid when people didn't want to have any Canadian in their portfolio or didn't want to have any international, like ex-North America in their portfolio.
Yeah, no, I made a comment to clients in a note as well. And it reminded me of this phrase from a Greek philosopher, and basically paraphrasing it, but a man cannot walk into the same river twice, because he's not the same man and the river is not the same river, right? Like, things change, right? People change over time. The river changes over time. The water flows, right? Even though it's still the North Saskatchewan River, for example, it's not exactly the same river as you saw it yesterday, right? And so when you talk about the world index, for example, it was not 70 odd % 2 years ago, 5 years ago, 10 years ago. So you may have the very same holding, right, on your investment, statement. But then if you look underneath the hood, that same named index is not the same index as what it was. So, that diversification, are you actually more diversified? Are you more concentrated? You're probably more concentrated than you actually expected. Certainly more concentrated, nothing else changed from even just a year ago.
Typical global fund, as I remember it in my earlier days, was 60% rest of world, 40% US. It seems like you're overweight US anyways at 40%, 60% for the entire rest of the world. But now over 70% US. And, I think as investors, we should be mindful of that. And if we're adjusting anything, that global fund you own, it's not international. Some people believe a global fund is international outside of North America.
Let's talk about this. Global, international. And we've talked about some of these terms before, but it's worth mentioning the differences.
Just to give you an example here, sometimes I'd hear from people, prospects usually, they would have S&P 500, an S&P 500 ETF, and then they diversify that with something like XWD, the iShares MSCI World Index. Here's what I see a lot, especially on Twitter. People have portfolios of SPY, the S&P 500 ETF, the triple Qs, NASDAQ,
United States also.
And they'll have something like URTH or VT, a global index, basically.
All world index.
All world, whatever you call it. So the top holdings of the S&P 500, and let me just share my screen so people can see this on Y charts.
So as a precursor to this, right, we're North America centric, right, because we live in North America. International means anything outside of North America. Global means the entire world. And I guess,
including Canada.
Including Canada as well. Canada roughly is 3% of the global equity market right now still,
just
right?
About exactly now, yep.
Right. So when you buy a global fund as a diversification tool, 2/3 of it is more America, right?
Yeah. Top holdings. And again, if you have a portfolio of SPY, the triple Qs, and a global ETF, here is the S&P 500, top holdings, Apple, NVIDIA, Microsoft, Amazon, Meta, Alphabet, Broadcom. Here is the triple Qs.
I've heard of those names.
Apple, NVIDIA, Microsoft, Amazon, Broadcom, Meta, Tesla. Here is URTH, Apple, NVIDIA, Microsoft, Amazon, Meta, Alphabet, Broadcom. And it's just different concentrations, the global index is still 5% in Apple. SPY has 7% in Apple and triple Qs have 9% in Apple. It's just triple Qs are obviously more concentrated in technology.
Yeah.
And the URTH basically just dilutes the US by a little bit, if you're looking at a 73% US to 27% rest of the world, it's not much of a dilution. Like, where is the first real global company in this list here? You have to go down quite a bit here, I think, to
TSM. Maybe Taiwan Semiconductor.
Over TSM, it probably is Taiwan Semiconductor. This is an entire page of American companies. Like the whole first page is American companies. Like it's insane. I've never seen it that concentrated
before. Because the United
before.
States, to your point, is 2/3 now plus of the entire world equity market. So how are you diversifying? It sounds like, I'm diversifying into this technology index, or I'm diversifying into this world index. No, you actually really need to make sure that you understand, an international index might do that. And then that's when you're going to start getting some European names, some Japanese names, some Chinese, and what have you, right?
Page 2 here. You got ASML, SAP, Novo Nordisk.
Okay. So then we got some European names coming in there, right? From the Netherlands and Denmark. And so, to even get that more concentrated, to go further on the concentration index, all those names tend to be those Mag 7 names that we've, time and time again referred back to, right? So all three of those indexes, S&P, NASDAQ, the world index that you just, all three of those examples that you brought up, they're all basically US mega cap companies, right? And so it's, talking on various points, it's hard to diversify away from these names, right? But it is possible. But if you do want to diversify, make sure you understand the plumbing, right?
The summary of this is there's nothing wrong with owning just a global ETF as your only equity holding. Of course, keeping in mind what your risk tolerance and time horizon is and all that stuff. But if your only equity holding is just one global ETF, that's fine. Just understand that if you're owning the three that I mentioned, you're not diversifying anything. You're just basically duplicating stuff. The same way as that client at the bank was when they owned the dividend growth, the dividend income, the monthly income. Those were just different asset allocations. They go from 100% stock to 60% stock.
Yeah.
So, and getting back to what we were talking about originally, excluding countries, letting your politics kind of drive your decisions, I don't think it's a good idea. And if anything, sort of be neutral to all that. Consider that today, as I said, the allocation between U.S. and international has changed so much from 40% U.S. when I maybe 10 years ago or so was still at 40% U.S. to now 70 something percent. Maybe it's worth considering if you're going to diversify anything, own that global ETF alongside with Canadian and international to dilute your U.S. a little bit. Now, if you did that last year, you reduced your returns because the U.S. continued to do really well. And nobody really knows what's going to do well in the future. One thing of note, in the longer term, U.S. and purple versus various other ETFs that I chose represent different countries. The U.S. looks great. And now if we invest based on this as our guide, it seems to tell us, invest in the U.S. 13% annual returns over the last 10 years. What did worst here? China annualized about 2% over those 10 years. Emerging markets did 3%. And emerging markets, again, looking back to when I started in my career, the one thing people were looking to diversify into back in 2006 was emerging markets. Because back then,
China,
they did awesome. China, India,
gangbusters,
Brazil, Latin America, Russia even. They all did great. Everyone wanted to buy. That was the last time people were really excited about emerging markets. Since then, what's happened is first they really underperformed in the late 90s. So they were catching up and they outperformed and everybody then piled their money into them. And then because of that outperformance, the following years, they underperform. That's just what markets do. Any type of investment. If you have a stretch where it really outperforms for a while, eventually it's probably going to mean reverse.
Catch a breather. Especially
when it's a market. It's not a single company, right? The U.S. is now in this situation where it has outperformed for quite a few years. Japan was one that really outperformed in the 70s and 80s and then really underperformed. We see Japan here average 5% annually. And it tells you something about expected returns. And the one bit of information you can glean from a price earnings ratio, we probably talked about this before. There are people out there, they're perma bearish because they see the CAPE ratio, the cyclically adjusted price earnings ratio. And because it's so high, they believe that we should stay out of stocks. That type of a ratio tells you absolutely nothing about market returns over the short term. There's no reason why a high CAPE can't become even higher over a couple of years. But they do give us an idea of what we can expect for returns in the future. And that told us, when prices were really high in 2000 for U.S. stocks, returns were lower from that point forward. When prices were really high for Japanese stocks, they went lower from that point on. Here, the worst performers are the ones that had a really high ratio or higher than average, like China, back about 10 years ago. And the ones that did better, probably the U.S. had a lower, more reasonable price earnings ratio back in 2015. But anyways, this is what they did over the last 10 years. Let's look at over the last 3 months. And 3 months is super short term, I know. But what's done well this year so far? China, 14% in the last 3 months. Germany up 14.5%. Canada, not so great. Probably some political issues here. I mean, it kind of goes against what I was saying, right? Don't invest based on politics. But it means stocks are staying cheaper in Canada for a little while longer, and this is not a reason to avoid them because they are cheaper than other parts of the world. And the U.S. has just been kind of meh, only 4% for the last 3 months, underperforming Japan. Even the U.K. is doing quite a bit better than the U.S. That's kind of embarrassing, right?
I'm going to take extension of this comment and say that even in your career, right, however short, it's been. I mean, it's been a couple decades for you, far less for me. But you've seen regimes where China, emerging markets, and Canada, by proxy, was the place to invest. And no one touched the United States.
They were the bee's knees.
Right? And right now it's inverted. So it goes to say that in the next decade, in the remainder of the 2020s or maybe the 2030s, in our lifetime, something else could switch, quite likely will switch, right?
Completely.
And so even though US mega cap growth is right now is the thing to be, right? You can't ignore that, the past performance. But on a go forward, it's quite possible, quite feasible, quite realistic, right? It's a likelihood that it won't be at one point, right? And so keep your mind open,
and I'm saying,
to that.
I'm saying I've had these conversations before, and I remember the exact opposite, the 180 degree from this. And I mean, imagine,
I haven't gone through that.
Imagine people listened to me back then. I was a brand new advisor at the bank, and maybe people didn't listen to me because I was too new and didn't know what I was talking about.
What is he talking about?
If they listened and properly put a good amount of money into U.S. equities in the 2010 era, there, 2011, for example, where people got scared out of U.S. equities because there was this debt ceiling talk, and the markets were going down a fair bit at that time. They avoided European equities because of the what was going on in Europe, the whole pigs thing.
Yeah.
But that was a fantastic time to get into those equities, both U.S. and Europe. And if people simply followed my advice and reduced their Canadian from 100% to maybe 50%, diversified into the rest of the world, they did really well. And like I said, today it's the opposite. It's don't pile all your eggs into the U.S. basket and expect lower returns. Do not expect anything close to the 12% or whatever that U.S. equities did. You might be surprised if it's any higher than 6%.
Yes, even if you stuck with the S&P 500, for example, you're right. Right. Yes. So, you've seen it in your career. We're gonna see it again in the career, like I said, as we expected in all of our investment lives. It'll be interesting to see when we flip this conversation again, yet one more time. It's unlikely to be next month. It's probably unlikely in the next 3 years, but you never know. And certainly within a decade, right? Or plus. So we're obviously these conversations keep coming up. Result out of all this chatter today?
Let's sum it up. Don't invest everything in one area. Don't chase the past winners. Don't let politics interfere with your investing. And what else did we cover today?
Cheesies.
Yeah, trade wars and stuff. If you're going to base your grocery purchases on politics or trade wars or whatever, fine. It's not going to have if you pay a little bit extra for those. What are they called? The Canadian ones? I only know Cheetos. Cheesies.
Traitor. I'm going to hang up now.
If you spend a bit extra buying those, it's not going to hurt you as much as if you make decisions with your portfolio to boycott U.S. stocks or go full in on last year's winners.
Yeah. But as consumers and investors, we can have that. We have agency in how we decide to spend. Your vacation might be chosen elsewhere. Your snack food might be chosen differently. Your ketchup might be chosen differently, right? That's entirely within our power and our reason. I'll cheer for Canada tonight. Absolutely. I'll eat my cheesies while I'm watching the hockey game tonight. Unlike you.
So let's record two different alternatives for the result of the game. So that was a great game yesterday, wasn't it? Where Canada beat the U.S. by insert score here.
Yeah. We'll leave it at that.
All right. Sounds good.